Investors think that if a property cash flows, it's a good deal. That's totally wrong. So listen up. Just because a property or a multifamily property looks good on paper doesn't mean you're not overpaying for it. Now, here are 3 red flags that tells you if a property is overpriced and that can cost you real big. So I get it. You see a deal and you think, if the numbers work, I'm good. Multifamily always appreciates, so I can't lose. It's a competitive market. I better grab it before someone else does. But that mindset is how people lose millions in real estate. I've seen investors buy overpriced properties, get stuck with negative cash flow, and never recover. So let's expose the 3 signs you're paying too much for a multifamily property. Number 1 that tells you you're overpaying for a property is cap rate lies. If the cap rate is lower than all other similar properties within the same comps, that tells you you're overpaying for the property. The market dictates the price, not the seller's emotion. Secret number 2 is inflated rent projections. Sellers love to tell you that rent will always go up, but that's a wrong assumption. If the rent, what is the current rent history compared to its own comps? If the rent doesn't match the market data, that's a huge red flag. Secret number 3 is high expense ratio. If the operating expenses is above 50% of gross income, that means run. Otherwise, you'll be paying for maintenance, utilities, and overhead costs. You don't want to buy a property that is dealing on high expense ratio. Before you buy your next multifamily properties, make sure to get your hands on my free multifamily red flag checklist that identifies all these red flags and prevents you from losing your hard-earned cash. DM me red flags today to get your hands on this free